FICO and the credit bureaus need each other. There's a very symbiotic relationship between the reports and scores and revenue model. But yet the credit bureaus have also stood up their own competitor to FICO, which is VantageScore. And even though FICO is used in 90% of lending decisions and VantageScore is more behind the scenes for looking at your own score or doing pre-screen marketing, VantageScore is moving into federally backed mortgage lending alongside FICO, not as a replacement, but alongside.
Welcome to Keys to Real Estate. I'm your host, Mary Schuster. Well, today we're talking about some interesting developments that everyone in the real estate, lending, and settlement sectors should have on their radar. Joining me is Ted Rossman, Senior Industry Analyst at Bankrate, where he covers consumer finance, credit cards, and broader economic trends. Ted is widely seen in major media outlets and is known for making complex financial shifts understandable and actionable. In our conversation, Ted walks us through the changes coming with the new FICO models, how buy now, pay later data, as well as trended credit information, are reshaping risk assessments, and what these updates could mean for borrowers, lenders, and professionals across the real estate ecosystem. There's some interesting pricing information you'll want to be aware of too. So whether you work directly with consumers at the closing table or originating loans, or if you simply want to understand what's behind the evolving credit decisions, Ted helps break down what's changing and how to stay prepared. So please enjoy this conversation with the engaging Bankrate's own Ted Rossman. The presenting sponsor for this season of Keys to Real Estate is Closing Lock. Working in title, do you ever feel like you've got a target on your back? Every year, $2 trillion moves in and out of escrow accounts in the United States. Fraudsters are watching and waiting for one wrong click, one unsecured email, just one oversight. And then just like that, your client's life savings are gone. That's where Closing Lock comes in. Closing Lock provides title companies a secure, all-in-one platform to prevent fraud, protect funds, and streamline closings. Over 1 million home sales have closed safely without incident in Closing Lock. Fraudsters only have to be right once. Title companies have to be right every time. Closing Lock has your back. Visit closinglock.com today to learn more. Ted, welcome to Keys to Real Estate. Thanks for joining us today.
Good to be here. Thank you.
Well, we have a lot to talk about. We've got some new FICO score models coming through. And I think for our audience who are obviously real estate and title and settlement professionals, but they're also individually consumers, we really need to talk about what's coming on. So let's let everybody know what to expect and what's the problem these new models are trying to solve.
Well, FICO's latest and greatest, FICO 10T, is all about trended data, basically seeing what's going up, what's going down, specifically things like credit utilization. So that's credit you're using divided by credit available to you on things like credit cards. Historically, there's been no memory associated with this. It starts fresh every month. So if one month you're using $4,900 out of a $5,000 credit limit, that's not great for that one month, but if you pay it all off next month, it's all wiped away. Moving forward, there's going to be more tracking over the past couple of years and seeing, are these persistent spikes? Are they occasional? The way this relates to lending is that the latest and greatest FICO technology may be an upgrade over what they've used before, but it's not necessarily implemented by lenders. A lot of lenders are using older operating systems, kind of like your phone or your computer. There's all these different versions, and it costs money to upgrade. There's a learning curve, there's time, there's training. The most commonly used FICO system is actually FICO 8, which came out more than 15 years ago. So just because something is available doesn't mean that people will necessarily be using it right away. That means that some of these new bells and whistles, whether it's trended data or the inclusion of buy now, pay later, it's going to be a slower rollout than you might think just based on the headlines.
So if I were a lender, why would I potentially be more interested in looking at the trended data? Like, am I at a disadvantage if I'm using that 15-year-old more snapshot model that you mentioned in the FICO 8?
Some lenders like the old way of doing things because it's tried and true. Really what this is all about is a numerical representation of how likely someone is to pay them back. That's really what a credit score is supposed to be doing. And change comes slowly in the credit scoring world. A lot of lenders are very regulated, but they're also traditional. Like they don't want to break something that didn't necessarily need fixing. So if they're comfortable with it, they've been using it for years, their staff knows how to use it, they trust the model. It's all about risk assessment. Now, there are always new ways of doing things that could potentially be better. There's also the competitor vantage score, which is not used as widely in lending decisions. That's more of a pre-screen marketing offer kind of thing and more for your own education on the various credit scoring sites. But they actually just recently got approved for use in federally backed mortgages. So that's adding some competition there. There's a lot going on the price side of things where FICO just recently changed their whole pricing model, and now they're going more direct to lenders, and that can potentially lower fees, but it also creates a bit of an end around the credit bureaus. So they're not happy about it, and their investors are not happy about it. One might say competition is a good thing for consumers. Some of this takes place kind of inside baseball. It's not something that the average person knows a whole lot about. There have been a bunch of notable changes in recent years. Medical debt has come off a lot of credit reports, and I've had some loan officers and executives tell me that this is a difficult environment to be lending in. There's a lot of uncertainty right now when it comes to the economy and inflation and tariffs and all these various factors, the job market. So every company is going to design their risk management process a little bit differently. Some of them are leaning into these new tools. Other ones are saying, let's not break it if it's not, doesn't need fixing. And they're still using the way they've always used it in the past. But it'll be interesting to see how this moves forward because there have been a number of new developments with buy now, pay later and medical debt and pricing and some other things.
If we could double click on that, especially the buy now, pay later, I think, because that does start to support some of the arguments of, well, maybe those older models aren't taking everything into account they should have. And while you mentioned medical debt coming off, which can kind of move a borrower a little bit up the scale, some of this buy now, pay later, I don't think a lot of us, especially older types, we see it when we go to checkout. We see the Infinity or Klarna or whatever the brands are. I don't know that we've thought about how that's really impacting indebtedness versus these credit reports. And so my mom used layaway in the 70s now and again. She was a fan of that. So let's talk about some of the details of the buy now, pay later, and then as it relates to it being reflected in some of these new scorings.
Some people even call buy now, pay later reverse layaway because it's really a new twist on that old concept where you pay something off in installments. One big difference versus credit cards is the installments are fixed. It's not like credit card debt where you're revolving a balance for potentially a long time. It's different amounts every month. Buy now, pay later, you're committing to a fixed payment schedule. Maybe it's 4 interest-free installments over 6 weeks. Increasingly, these plans are lasting longer, maybe 6 months, a year, 2 years, but there is built-in light at the end of the tunnel. Exactly how much you owe for exactly how long. It's been a blind spot for the credit industry, though, because it doesn't fit neatly into our traditional understanding of credit. With something like a credit card, opening too many too quickly is a bad thing. That just makes you look like a risky, desperate borrower. Maxing out an account is a bad thing for the same reason. It just makes you look tapped out and desperate. And who would want to be the next lender in line if someone's already maxed out on their existing credit? Buy now, pay later, by definition, though, involves frequently opening and closing accounts. Because purchases are typically underwritten every single time you buy something, it's not like your open-ended $5,000 credit limit. It's, all right, you're approved for $200 for that purchase, and maybe it's $300 for this other one, but you're essentially maxing that out and then paying it down, usually relatively quickly. It's a square peg round hole thing with respect to the credit scoring algorithms. They really just haven't known what to do with it, and they haven't really done much with it until recently. FICO is now, as of this fall, incorporating buy now, pay later into its latest and greatest T model. There are still some limitations, though. Not every lender is upgraded to that, of course, but also on the provider side. Affirm has been a leader saying that they're reporting their buy now, pay later plans to the credit bureaus. Klarna and Afterpay, on the other hand, have said they're not going to do it for now. And they're actually worried about unintended consequences. That's their public argument, that they don't want their customers to potentially be hurt by this. Now, FICO says the vast majority of borrowers are not going to be hurt by it. There's also some other reasons at work. It's actually effort and time and money for these lenders to stand up new departments to handle all of this. And What do you do about dispute resolution? What do you do about all the back end infrastructure? It's a burden to them. And I suspect, even though they're not saying that as loudly in public, that's probably another reason why many have not yet jumped on board. So, kind of long story short, buy now, pay later is slowly making its way into credit scoring, but it's by no means mainstream and it's been slow going. And that's actually unfortunate, I would say, for lenders who have a blind spot. Like, you don't know if someone's used this a whole bunch, if they've fallen behind, if they have a lot of debt, or conversely, if they've used it properly. But then also from a consumer standpoint, a lot of buy now, pay later users are younger. They don't necessarily have great credit or any credit. I would say using it responsibly should help them. And like any credit product, using it irresponsibly should ding them, whether they're paying late or running up too much debt. It's going to be slow going though.
Well, I wanted to ask you about that younger demographic where this tends, at least today, to be more popular than with some other demographics. Do they have an aversion to traditional credit cards that they see this as an option for, or is it just that it's presented right there at time of checkout and a good option? Part two, sometimes if they're making those options instead of the traditional credit card, they're not getting validated right now through FICO and others.
For most people, young adults included, it's not really an either or, it's both, meaning that they have buy now, pay later, and they have credit cards, and they deploy them selectively. This has been an interesting trend in payments the last few years where the lines are blurring. Even traditional credit card brands like Amex, Chase, and Citi, they all have their flavor of buy now, pay later. And the buy now, pay later companies have their version of what looks like a traditional debit or even verging on credit card. Klarna and Affirm and Afterpay all have these payment cards where it's technically a debit card, but you can use it at the point of sale, including the grocery store, the gas station, e-commerce, anywhere. And you can either pay it off right away like a debit card, or you can turn it into an installment plan. So it's really becoming more of a holistic kind of payments ecosystem. Even a company like Klarna, we think of them as buy now, pay later. They're trying to be all things to all people. There's the debit approach where you pay now. There's the 4 payments in 6 weeks where you don't get that much time. Or there's maybe the 12 or 18 or 24 month plan where you get a longer time to pay off a bigger purchase. So definitely the lines are blurring here. TransUnion has some interesting research that shows that Gen Zers are significantly more likely than millennials were at the same age to have credit cards. They're also, sadly, more likely to have higher amounts of credit card debt. Some of that says a lot about the current moment, which is high prices, high interest rates, high cost of living. Some of it also seems to be generational in that millennials were famously debt averse. They were slow to get credit cards. Buy now, pay later didn't really exist when they were coming into adulthood. They were scared of debt. And that was because of scars from the Great Recession. Some of it was regulatory developments that made it harder to get a credit card. Millennials have eventually climbed on board with credit cards, but Gen Zers have been bigger risk takers with their money from day one. And I don't want to seem like I'm blaming anybody. I mean, I get it. Life's expensive. You don't want to be in debt. But we also see Gen Zers taking more chances, whether it's credit card debt, buy now, pay later, crypto, meme stocks. They're not as debt averse as millennials were when they were that age.
Yeah, that's a really good point. I'm starting to notice some of those trends myself. I don't really have a lot of Gen Zers directly in my life, so I have to get it, here and there. And it does seem that that's true. They're a little bit more mavericky about how they roll their dice.
That's definitely fair. Yeah. Now, some of that is they came of age at a different time. So millennials entered adulthood largely around the Great Recession, tough times for the economy, for lenders. A lot of Gen Zers came of age really around the COVID time, which was
0%.
Difficult from a
2%,
societal standpoint and from a health standpoint, but monetarily,
interest rate,
money was actually abundant because there was all this stimulus money washing around, and you had a lot of bored Gen Zers at home basically gambling on meme stocks, crypto, sports
betting.
There's actually evidence that that has transferred into other forms of their finances, whether it's stocks and other investments or alternatives, or even something like buy now, pay later. There is a strong impulse buy angle. There's the e-commerce angle where kind of scrolling through, it's like, do I want to buy this thing? Well, oh, they said I can split it into installments. that sounds a lot better. It's kind of the infomercial thing. It's 4 easy payments of $29.99. Sometimes you lose sight of how much you're spending. From a lending standpoint, though, lenders would definitely like to know because some people have a lot of these plans running at the same time. And even if it's $50 here and $100 there, if you have 10 of these plans running at the same time, that can add up. And also, if you're behind on 4 of them, that doesn't make you look like a great lending risk. So I actually view this as one of the real blind spots in the credit reporting system that will hopefully be fixed in the years to come. Buy now, pay later is still small relative to credit cards, but it's growing rapidly and it's past time. We can't ignore it any further.
Yeah, agreed. Well, I wanted to come back to a couple of things you touched on briefly there. I'm wondering, I wanted to circle back on a couple of things you mentioned. One of them, if I got denied credit through the traditional system, I would get like a reason code. I would be told what, and usually some little generic counseling about how to correct it. Do we see those things coming along yet in these new models, or do those have to be built? What's going on there?
Buy now, pay later is not beholden to the same standards as credit cards. Late in the Biden administration, the CFPB tried to hold it to the same standards as credit cards. And that means a bunch of different things, some of them having to do with disputes and monthly billing and regulating it as a debt product. And that has not stuck in the current administration with just a very different stance on consumer protection issues. That's something that even the big banks worry about, just that Chase CEO Jamie Dimon has talked about how fintechs are not playing by the same rules as big banks. Big banks are still very regulated. Even as the CFPB is doing less, there's a lot of regulation on big banks. There's not a lot of regulation on buy now, pay later and other fintechs. And some people say that's good and that encourages innovation. And other people say, well, that could lead to bad outcomes. Buy now, pay later has never really been recession tested. I realized there was that sharp, albeit brief, recession at the onset of the pandemic. That was different, though, because like we said, there was a lot of stimulus money. There were tons of accommodations on the part of lenders. People were hunkered down. They were spending less. And that was just very different. A lot of these buy now, pay later companies launched after the financial crisis. So we're talking companies that are maybe 10 years old is kind of a typical example. And that's actually very relevant to the current climate where unemployment's going up. And there's a lot of uncertainty about the path forward, whether we're talking jobs or we're talking inflation or what happens with tariffs, what happens with Fed independence, what happens with any of this stuff. So the uncertainty meter is pretty high. That said, delinquencies are really low on buy now, pay later, and that is really surprising to a lot of people. One of the biggest explanations is users like it and they want to keep using it. They want to stay in good graces. Affirm has a lower delinquency rate than credit cards, which is, again, really surprising for this kind of unsecured debt that feels easy to get. And young people, they don't have great credit. They like the service. They want to keep using it. These buy now, pay later companies also point to proprietary underwriting methods, the fact that it's usually pretty short-term debt. There's a little bit of a feeling of, oh, how much trouble could you get into with a $200 6-week loan? You can get into some trouble, especially if you stack loans on top of loans. In general, though, buy now, pay later is one of these things where the bark has been worse than the bite. A lot of people have been warning of consequences that to date just haven't really arrived.
All right, fair enough. And then another thing you mentioned that I wanted to spend some more time on, you mentioned that FICO is allowing mortgage lenders to license scores directly, which would bypass the credit bureaus. That sounds like it could shake up some market share and some pricing. Would you talk through that for us, please?
It already has, yeah. So what's really interesting here is that FICO is the scoring company, and then they've layered their scoring methodology on top of the credit reports, the information furnished from lenders to companies like Experian, Equifax, and TransUnion, the big 3 credit bureaus. The funny sort of friendly competitor kind of thing that goes on here is that FICO and the credit bureaus need each other. There's a very symbiotic relationship between the reports and scores and revenue model. But yet the credit bureaus have also stood up their own competitor to FICO, which is VantageScore. And even though FICO is used in 90% of lending decisions, and Vantage Score is more behind the scenes for looking at your own score or doing pre-screen marketing. Vantage Score is moving into federally backed mortgage lending alongside FICO, not as a replacement, but alongside. But yeah, this move recently was a pretty big shot across the bow from FICO. They basically undercut their partners here and basically said that they're going to offer these credit scores directly to mortgage brokers at a lower price. And it really cuts Experian, Equifax, and TransUnion out of a good bit of the process. Equifax actually responded by lowering prices and trying to fight back in that way, which you might say is good for the overall ecosystem if competition stimulates lower prices. It's going to be interesting though, because for now, this is just for mortgages and it is a bit of inside baseball. There are these companies like iSoftPull that are known as tri-merge resellers. They basically package the three credit bureaus scores. Back to that point about different operating systems, you might have a different credit score from Equifax versus Experian versus TransUnion. So now the FICO is allowing these tri-merge resellers, these kind of middlemen of credit scoring, to basically repackage and license directly the FICO score. These ultimate lenders and mortgage brokers don't need to go separately to pay Equifax $10 and TransUnion $10 and Experian $10 every single time they run credit. It's going to be basically $5, and then there's a $33 fee at the end if the loan ends up getting closed. So it's actually very much in the spirit of transparency or pricing. I just wonder behind the scenes, is there a bit of biting the hand that feeds them? Because FICO without the credit bureaus doesn't have much of a business. But then again, the credit bureaus haven't been able to have Vantage Score adopted as widely by lenders as FICO. So they kind of need each other, but they're kind of fighting it out a little bit behind the scenes. So it'll be interesting to see where it goes.
Yes, I agree. And with all these new factors and trying to keep that balance right? The lender's risk profile, what the borrower should be having considered, rents. I should let people know that we're recording in mid-October, and Director Pulte just today was back out applauding a vendor in the space, not lender, but online brokerage valuation space, for shifting their model to include rents as credits for borrowers. So I think for some of these younger and thin credit file borrowers, there could be some real lift here. And I think it sounds like it has potentially the added advantage of giving a lender a more holistic view of what's really going on with a borrower systematically.
That's the idea. Rent is an interesting example because it's a very old traditional financial product. I mean, people have been paying rents forever and ever, and yet it's still not mainstream on credit reports. Some of that is because a lot of rentals are these mom and pop kind of small operations. Some of the bigger property management companies report to the credit bureaus. It's hard for the one-offs. Like if someone's renting a spare room in their house or they own 5 apartment units or something like that. That's one of the reasons why it hasn't been widely reported. But from a consumer standpoint, your biggest financial obligation every month and paying your rent should be very indicative of credit health or lack thereof. Very predictive, you would think, about paying a mortgage or other things. That's actually one of the reasons medical debt came off credit reports for the most part, is that it's not as predictive. So you think something like rent should be very on brand, but it gets back to that point about change coming slowly. There's logistical hurdles with gathering this information, reporting this information. In the last few years, we have seen movement on things like getting more rent reported. There are a whole bunch of services people can subscribe to, things like Rent Track and Rental Karma, and Experian Boost is pulling in some rents. Built, which has a popular credit card now and really leaning hard into that young professional renter kind of space. Built has a mechanism for reporting rent, but a lot of rent is still not getting reported. Streaming services, utilities, these are starting to pop up on credit reports. Not always, but if you opt into certain programs like Experian Boost or eCredible Lift, some of the upshot for consumers is that they need to be their own advocate. And especially if they're not using traditional credit, like credit cards and auto loans and mortgages, one of the best ways to build a credit score is to sign up for all these alternatives, but it's fragmented. It's on you to remember to do it. Sometimes there's a fee involved. It really would be ideal if we saw more of this reported just as a traditional matter of course. But all these things, it's going to take time. Rent, utilities, buy now, pay later. they're starting to appear, but it's fairly slow going.
Yeah. All right. Well, since there's no mandate for this use, and obviously, if someone's in charge of a bank of whether to employ there's not, they're going to have a whole different set of things to consider. But for the loan originator, for the settlement officer who are going to be having consumers coming in and asking about these types of things, and since we're going to be sort of on a parallel path probably for a while with these scores, like what do you recommend for professionals in the business just to kind of keep their eyes open and have as a simple way to explain to consumers some of these differences that hopefully will accrue to their benefit?
Sometimes it would make sense to coach clients on signing up for these kind of programs, because especially if somebody's on the border between getting approved or denied, or maybe they're on the border of different rate tiers, and if they improve their credit score, they can get a better rate. Helping to educate people about, like, hey, if you signed up for Experian Boost, you can maybe improve your score because it can pull in your rent or your streaming plans or your utilities or things like that. Or maybe using a company like a firm that is going to report to credit bureaus, maybe that becomes a bit of a competitive advantage, that if you're trying to build credit using buy now, pay later, maybe you ought to use them. Now, for mortgage lending, we're still waiting for approval of FICO 10T for federally backed mortgage lending. So that's another hurdle. Mortgage lending has been the most regulated, the most slow moving of all the credit products. Whereas I mentioned FICO 8 is the most used for things like credit cards and auto loans. It's actually FICO 2, 3, and 4, these decades old systems that are the ones that are approved for mortgage lending. Now, the government's been in the process for years about certifying T. They were supposed to do that alongside the latest Vantage score. They actually ended up kind of splitting it, and they did recently approve Vantage score 4 alongside FICO, but it just takes time for all this stuff to get implemented. So it ends up being fairly fragmented, and a lot of the onus is on consumers to find ways to improve their score, especially if they're around the margins. There are things you can do, but they don't always translate to every type of lending. Like signing up for Experian Boost could boost your odds of getting a credit card, but it's not necessarily going to help with your mortgage right now.
That makes a lot of sense. Well, and I know we do a fair amount of kind of backhanded mortgage counseling. A lot of times people in the title settlement industry and a lender and a realtor will go out and do like a first time home buyers workshop for those that have the goal of home ownership, and they work on a lot of these things. And I just really wanted to come on today and have you explain some of these changes and also how the landscape is really evolving. And so the formula that worked 6 months ago that could help a potential buyer get ready to actually buy is probably going to be a little bit different. And just, I think it sounds like staying aware and nimble and being able to talk through some of the elements of these things would certainly be helpful for consumer and your professional alike, I would guess.
And it's very relevant to the current rate climate as well, because right now the average 30-year fixed mortgage rate is about 6.5%. We've been waiting for that to come down, and it has come down to some extent. A couple of years ago, it was 8%, but it hasn't budged that much this year. And a big misconception among a lot of consumers is, well, the Fed's cutting rates, mortgage rates are going to follow. Not necessarily. Mortgage rates tend to track 10-year treasuries, which are looking more long-term. What's investors' outlook for inflation and the state of the job market and the state of the economy, and all this political talk about Fed independence or lack thereof, it all gets kind of wrapped up. And certainly with prices as high as they are, prospective home buyers are really worried about affordability right now. And every little bit they can trim off their rate can be really meaningful. If you can get your rate below 6%, and some people can, even with the average at 6.5, if you have good credit, if you shop around, you can get it under 6, but it's not like 2 or 3 where it was a few years ago. So it's just a very rate conscious environment right now, which makes it a very credit conscious environment, because that's one of the biggest inputs into rates. I do think that we could see that average fall below 6% by early next year if all goes well. Still a lot of room to go before somebody with a 3% rate that they refinanced 5 years ago is going to get off the fence and sell potentially. But every little bit counts, and your credit score is a big part of that. The fact that you can save tens of thousands of dollars in interest over the life of a 30-year mortgage by having a better credit score, that just makes it all the more important.
Not to ask you to be in the prediction business, but we're doing a lot of 2026 planning here in our world. my watchword in advance for 2026, or my keyword for the year, is just going to be capital change. I just think we're going to see a lot of change. And I hope that doesn't mean volatility, but it might. Are you, as you are thinking about 2026, do you have sort of a prelim watchword that you're thinking about might encapsulate the year?
Yeah, I mean, this year has been a big year about uncertainty. Maybe we'll get the answers in the month to come. I'm sure we'll get more questions too, but maybe we'll get some of the answers. I feel like some of the biggest questions right now have to do with inflation, the state of the job market, who's going to be the next Fed chair. Now, right now, a lot of economic data is on hold because of the government shutdown, so that's not helping. The new Fed chair will be interesting, and this could definitely relate to things like mortgage rates, because on the face of it, we know President Trump wants lower rates, and he's very likely to appoint a new Fed chair who's going to have lower short-term rates. The Fed, though, doesn't have as much say over long-term rates. Those are set more by investors. And the real wild card here is if someone comes in and just slashes rates just because the president wants them to, that could actually undermine this notion of Fed independence and could actually push long-term rates higher in a weird sense. But the reason being, if investors feel like the Fed's not serious about fighting inflation, inflation could come back. So if they just slash rates and then that overstimulates the economy and inflation rears its head and it doesn't go from 3 to 2, instead it goes from 3% back up to 5%. I mean, this would be a bad scenario, especially if the job market is stalled. I mean, that's the nasty stagflation thing. This is very hypothetical. This is sort of like worst case scenario. So hopefully this doesn't happen. But that's actually one of the reasons mortgage rates haven't moved a lot this year, is that we just don't know what's going to happen next. And the new Fed chair, I feel like, will start to provide some answers. If we get lower rates in a slow, steady, measured way for the right reason, which would be inflation coming down, that's going to be a lot better for mortgage rates than if rates drop precipitously because A, the Fed chair just kind of goes rogue and does that, or B, the job market rolls over. You know, if we get 7% unemployment, we're going to get lower rates, but that's not for the right reason. The base case is not for any of that. I mean, the base case is for unemployment to only rise slowly and for things to not be so bad. But there's just a lot of uncertainty. I mean, one of the big themes of this year has been the mood is down, but a lot of the data has been better. And that's been an interesting thing to track. That consumer sentiment's depressed, but people are spending, the economy's growing. Even tariffs, for all the gloom and doom about tariffs, to be fair, prices haven't changed all that much just yet. Now, some people say, well, it's coming.
Right.
These are things that we might know more about in a few months.
Yeah. Yeah. Well, it's always hard to wait and see. That's one thing that's always true. And I've never met a politician who was going to lobby for higher interest rates. So we'll see what happens. Just, Ted, we really appreciate your coming on to talk about these issues. I hope we can check back in with you in the future, maybe about a year from now, to see, did 2026 play out about like we thought it would, or what happened? But does FICO information and the buy now, pay later phenomenon starting to be incorporated a little bit into people's financial pictures, I think, is an important thing for mortgage professionals to watch, and for consumers, or our kids, as the case may be, just to know more about. So thanks for making it more accessible to us. We appreciate it.
I enjoyed it. Thanks for having me on.
Many thanks to Ted Rossman for joining us to help us unpack what's new in credit scoring and consumer credit trends. As we heard, like the FICO 10T rollout, the gradual inclusion of buy now, pay later data and new pricing and licensing models for lenders are going to influence how credit is evaluated and ultimately how deals get done. And for those of us in real estate, lending, and settlement, this is the kind of shift that might not grab headlines at first, but it will shape your conversations with borrowers and partners in the months ahead. You can read more of Ted's analysis at bankrate.com, where he continues to track these developments across consumer finance and lending. And we've linked all of his information in today's show notes. Thanks for joining us for Keys to Real Estate. If today's discussion helped you stay informed about what's coming, share the episode with your colleagues. Hit like, subscribe. That just helps more people find us. And please join us next time as we continue to explore the trends influencing the business of real estate. And we'll keep bringing you the knowledge that helps you maintain your competitive advantage.